Hey, what's going on, option traders? Hopefully soon to be option traders. My name is Bo Crable, founder of OptionScout, and in this video I want to go over an iron condor setup. So I'm going to talk to you about how you can set this up inside Robinhood, kind of why someone would trade an iron condor, and kind of just deconstruct it all. And then towards the end as well, I'll go over into my free software and show you how you can visualize this, see your max profit, your max loss, your break-even points, and so you can see like through a nice looking appealing chart. So yeah, let's just get right into it. So first off, what is an iron condor? Well, let's actually use Twitter for example. So I'm in Robinhood right here, and let's kind of deconstruct this. So really what an iron condor is, it is a short put spread plus a short call spread. Now, what are those? Well, a short call spread or short put spread would be someone who wants to collect income. So, you can sell a put to collect income. Now, if you sell a naked put, you have a lot of risk if the stock just tanks. So to mitigate that risk, you'll buy a long put. So I'll show you how you can do something like that. So let's do Twitter in this example, which, Elon Musk just went back. Well, first off, he was buying Twitter, and then he said, psych, never mind, too many bots, and now he's closing on to the acquisition. So I think an iron condor is actually kind of interesting here because the stock will probably stay a little bit below the buying price, which is $54.20. So, a little bit of hint, people will want to utilize an iron condor because they think the stock will stay in a certain price range, essentially, because that's going to be your max profit, which you'll see later. But anyhow, so this would be a short put spread. So you would most likely select a contract that is out of the money. So right now, Twitter's at 49.35. So let's say you select like 47. Okay. So you do that. Now so it's a short put. And you can see here your max loss is $4,600. And the reason for that is practically you're taking this 47 price times by 100, and you're subtracting the credit you're receiving. Now, if you want to really, really reduce your risk, what you can do is you can just buy up a long call, and now your max risk and also your collateral. Okay, your collateral is going to be the difference between the strikes, which is also going to be the max risk. But anyhow, so if you select this, watch this. You're going to see the max loss really. So you'll see the max profit decrease, but you'll see the max loss decrease a lot. So let's click on that. Actually, whoops, that's selling. So I need to remove that. Okay. This is why I use my own software, because it'll make it a little easier. Let's go like this, 45. So yeah, you can see right there. Okay, so your max profit dipped a little bit, but you can see your max loss is now 182. So practically, that's the first part of an iron condor, is a short put spread, which your max profit with a short put spread is the net credit you're receiving, and then your max loss is the difference between the two strikes. So now you're doing the same thing, but on the call side. So let's do that. Let's pick up a call. So let's do, again, well, I mean, if we look at here, Twitter, it's supposed to close any day now at 54.20. So, I mean, you can see these prices are actually really, really inexpensive. But, let's say you want to gamble a little bit and you feel like it's not going to stay above 54.20 because maybe the acquisition is going to take some time to close. So let's say we choose 53, which is, you can see why there's a big price difference and why all these are, because people are just not going to pay a higher price than this. It's not going to go over 54. That's why you see they're really, really inexpensive. But again, I'm just using this as an example purpose, but let's say we click this. So we sell this, okay? So we sell this. So now you can kind of see this is like, what we got going on. Now, it says our max loss is unlimited. Now, why is that? It's on the upside. So our max loss went from like $180 to now it's unlimited, because if you sell a naked call, you have max loss because or unlimited loss because the stock can keep going up, 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 and up. If you just sell a naked put, the stock can tank to zero and you have a huge loss. So again, to mitigate that, we're going to buy up an option. So, the stock is probably not going to go above 54.20 because that's what Elon Musk bought it at, or is buying at, so we can mitigate our risk there. So now you're collecting 30 cents, and okay, again, I need to change this to a buy. I'm way too used to using my own software. Okay, so now your max credit is 23, and you have a max loss of 173. So now what I want to go over, so that's the setup of an iron condor. Let's actually do the same thing inside OptionScout real quick. And when you go to OptionScout, you can actually see little charts and visualize everything for any type of strategy. We have right now over 30, but we're adding like 20 more strategies actually this week. So click on Iron Condor, and let's just set this up real quick. So let's go to Twitter, okay, and open an options chain. And let's just do the same thing we were doing. So I don't even remember the strikes we were doing it at, but let's do the call. So we chose, I think, 53, and then for the put we were selling, what was it, 47? Yeah, let's just pick 47. Okay, it might have been different. So then now let's buy out a 45. Let's go a 44 put, and then let's buy out a 55 call. Okay, so then let's kind of just minimize this options chain real quick, and so we can go back to it later, but let's just kind of put it down below here. Okay, so here's what you're looking at, right? So again, net credit 33, so it looks like we chose some different things. But look at this ROI. This is really, really high, right? And the reason for that is because iron condors have very low collateral levels. You know, if you sell a naked call, or if you sell a short put, and you're not doing any long contracts, you're going to have a really, really high collateral amount. And the reason for that is because you have a huge max loss. But now, you know, you can see this is your profit zone. Okay, so a trader is going to want to do this type of strategy if they think there's minimal movement, right? So Twitter is actually, I feel like there'll be a lot of iron condors playing out in Twitter actually this week and for the next weeks until the acquisition's actually closed, because people kind of know it's not going to go above 54, but it's going to stay right there. So a lot of short puts would be utilized. Actually, I traded some short put spreads because of that. You have a pretty high probability of profit, but now this is, with an iron condor, something to keep in mind, you have two break-even points. So you have a break-even point on the downside. So what that means is that the stock is going down, 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 you have a break-even point. So right around here, which we put right here, which is 46.67. So if the stock hits 46.67, I'm still in the profit zone, okay, but I'm not at my max profit anymore. So between 47 and between 53 is my max profit. So anything between there, if Twitter stays between there, I net $33 by only putting up $300 of collateral, or it might be $267 or so, right? Depending on the trading exchange you're utilizing this on. So yeah, that's a setup. That's the setup for an iron condor. Now, if you want to increase your risk or increase your reward and all that stuff, you just choose different strike prices. If we go back into the options chain, if we want to squeeze out more income, then we're practically just going to choose lower. And I'm not necessarily saying to do this. Again, this is not financial advice. But you just click lower strikes for the rights, the contracts you're selling, or you can choose further out of the money calls or further out of the money long options you do. So there, yeah, you can see, okay, this actually looks like I did it perfectly. So an iron condor, the correct setup is supposed to be equally apart from each other. So what I mean by that is, let's say stock is trading at 100, and let's say you sell a put at 95, you're supposed to sell a call at 105. And then let's say the long put you bought was at 90, then you would buy a call at 110. So it looks like I just accidentally did that right here. So this is what it should look like. It should look equally like this, where you can see now, we're actually getting a higher ROI, but you can see our probability of profit went lower. So if you want to increase your probability of profit, then you're going to pick a wider range, right? So for Twitter, for the example, maybe our right, if you want to really, if you want a really, really, really high probability of profit, which you won't be making too much money, you go 55 right call, and then you do 44 right put, and then you'd have now. If my longs are less than that, it's going to look a little bit wonky, but let's go long 58, and let's go long, 41. So this would be very high, yeah, really high chance of probability, but and this might not be bad, right? If you're okay, I'm okay making $15 off, putting up 300, 285, whatever you want of collateral. You have a really, really high chance of success, because it's this is a wide range for Twitter. Especially given the acquisition, it's that's almost free money at that point. But anyhow, that's an iron condor. That's a setup. I hope this made sense. So again, to remember, with an iron condor, you're doing one of everything. So you're selling a call, you're buying a call, you're selling a put, and you're buying a put as well. So see you in the next lesson. If you like things like this, definitely hit subscribe. It would mean a lot. Hit the like button as well. And check out OptionScout.com for free options trading software.